We'll find out tomorrow whether Donald Trump will stay in or back out of the Iran nuclear deal. An announcement is expected in the afternoon around 2 p.m. Eastern Time. Today, Britain's Foreign Secretary was in Washington trying pretty hard to convince the U.S. president not to scrap that agreement. All these political developments caused oil prices to pull back from its high after crossing past the $70 mark for the first time in a long time. I'm going to bring in Rory Johnston, commodity economist at Scotiabank Economics, to talk about what we can expect from Trump and the oil markets this week. So game this out for me. 2 o'clock tomorrow, Trump's going to come out. He'll make some announcement about the Iran deal, in, out, somewhere in between. What happens to the price of oil if he pulls the U.S. out of this?
If he pulls the U.S. out altogether, I think there's definitely going to be an upward reaction to the oil price.
And is it like dramatic and fast? Is it?
I don't actually think it will be. It'll be fast.
Because they've already priced in a fair right.
Exactly. So I think a lot of the rally we've seen over the last couple of days has really been a lot of that Iran risk.
Right.
But you have to balance the Iran risk. And I mean, even in a worst case scenario, we're probably talking 700,000 barrels a day, which is a decent amount of oil, but it's not going to happen immediately. It's going to happen over a series of months as refiners are able to diversify their kind of import slate. So I do think that markets have likely gotten a little ahead of themselves on what this means on the physical side. So while we talk about the Iran risk, we can also talk about the Venezuelan reality, which is while Iran, the risk to the production there is between 200 and 700,000 barrels a day, depending on the severity of sanctions enforcement. While in Venezuela, we've already seen production fall by upwards of 700,000 barrels a day over the last year. So and that's in our hemisphere. It's right fundamentally in our refining back door. So that's actually really pushing prices fundamentally higher, and then that's being helped by the Iran risk.
Right. I mean, the last time you were here, we were talking about the fact that for the first time, I think ever, there's more Canadian oil being refined at Texas refineries than there is Venezuelan oil, which is we're already seeing that play itself out. Is the other sort of scenario, or I guess one of the other scenarios we can see in Iran, is not just pull out of the deal, but increase sanctions? Like, if he jacks things up tremendously, is that where we can see things start to get a little...
That's, I think, if we start to see things jacked up, because, I mean, you also have to remember that the United States going back in itself is not the same as the entire deal falling apart, right?
Because the UK is still very much in, all of Europe is.
Yeah, exactly. All the former allies in that agreement are generally in favor of the agreement. So if the United States pulls out, there's a lot the United States can do by itself.
For sure.
Make no mistake, it is the United States for a reason on this side. But so what it's going to be able to do is it's going to probably lean heavier on financial sanctions, U.S. dollar sanctions, potentially sanctions on things like insurance, which will complicate shipping. But I do think it's going to take a while for those sanctions to go across, even if we do see a very aggressive snapback.
Right. Fair enough. What does this look like for Canadian producers?
So I think Canadian producers, it's good. I mean, higher oil prices, always good for Canadian producers. And what you also have to talk about there is that even though prices are, Brent's at 75, WTI is above $70 for the first time since 2014, and the oil price collapsed in the first place.
Right.
That's all very good for Canadian producers, and you couple that with the fact that the discount's fallen back. The WCS discount.
Was it like $30 a barrel, and it's gone down to, what is it now?
17, 18 bucks now.
Pretty good.
And when we have Venezuelan heavy oil falling off, that's also, in the medium term, bullish for Canadian producers, because all else equal, less heavy oil around the Gulf means more competitive Canadian crude oil.
The flip side, I mean, we're just looking at a chart here, the 5-year chart of WTI, and you can see it's been a rough ride for sure for everybody. With the discount, do you understand why it's gone from 30 to 15 or whatever, 17 now? It was down as low as 15 at one point.
Yeah, so there are a couple things factoring into this, and I should say at the outset, I don't think that the narrowing is permanent. I think that we're likely going to expand again throughout the year. What's happened in that first quarter after we saw some of the Canadian oil firms kind of come out with the results, what we saw is a lot of them held back production given the weak pricing environment. So that just had less barrels fundamentally kind of competing for pipeline capacity. That eased things up. In the summer, we're likely going to need less diluent in those pipes. So that's going to keep things loose.
And are they pumping less, the Canadian producers?
In the first quarter, they had held back production. Now, they weren't necessarily less than they were before, but less than they would otherwise be.
All right. And the shale play is going to come back into play. If we stay above 70, they're going to kick around forever.
Yeah, so shale is always going to grow aggressively under really any price scenario. The complicating factor for the U.S. shale producers is they're experiencing something very similar to what the Canadian producers are suffering, which is pipeline constraints. The Midland WTI benchmark has, the discount there has fallen from roughly at par to negative $12. So they're experiencing something very similar. So the U.S., the Permian Basin is not seeing this latest oil price rally.
All right, we're going to leave it there. Rory, thanks for this. It's always
Thank you
good to get you in. Rory Johnson, a commodity economist at Scotiabank Economics.